In this video, I'm going to show you how to use this new and revised kind of file that I use. It scrapes data from the internet, from Yahoo and MarketWatch to get all the financial statements, Yahoo to get betas and the stock prices and some other data. And I'm going to have one enormous theme. And this theme is that this famous number, this equity market risk premium, that one time I read that, oh, this was the most studied number in all of finance. What is this mysterious number? This mysterious number that reflects the earnings you expect on a stock relative to the earnings you expect on a risk-free instrument. Of course, there's no way to call a 10-year treasury bond anything close to risk-free when you have all this inflation risk in it. But how do we compute this equity market risk premium? And then there's a famous Ibbotson study, Singfield. They used to have an office, I think, in near where I had an office a long time ago. And they compute the returns you've earned on stocks and subtract the returns that you would have earned on bonds. And my proposition is that if anybody tries to make a calculation of the returns you realize on stocks from the stock price going up and including the dividends, wonderful data you can just plop out of yahoo.finance right now. If anybody says that, okay, we're going to take the actual index, the actual earnings you make on the stock, and subtract the amounts you would have earned on a bond without even taking account of the fact that if you buy and sell bonds, you can get capital gains and capital losses. If you just take the index of the stock minus an index of the bonds that just grows at a treasury bond rate, that's an absurd number. And that's the common way that these numbers are calculated. And I've got quotes that I'm putting on my website about that. That's the common way they're calculated. And the reason they're so full of crap in computing this equity market risk premium based on the actual stock return versus the bond return is you don't take account of changes in the cost of capital itself. You can see I get emotional about this. It's remarkable. It is remarkable that somebody would try to compute the equity market risk premium from historic data without accounting for the fact that stocks go up when the cost of capital goes down, stocks go down when the cost of capital goes up. And if you try to compute a market index without reflecting these capital gains and capital losses that are due to the changes in the cost of capital itself, you've got a completely meaningless number. So this big equity market risk premium number that's behind so much, and I've argued that it's generally way overstated, is crazy. And people can talk about, theoretical problems of the CAPM and, the arbitrage pricing model. What a bunch of shit. Sorry. I got to stop swearing. But when you plug in the numbers for the CAPM, that's where it falls apart. Plugging in an equity market risk premium that is an absurd number leads to all sorts of wacko a weighted average cost of capital or required cost of equity, which is the number. Don't say, nobody computes the CAPM really up. Everybody talks about what kind of return you really need on an investment all the time. It's an enormously important number, and it's distorted. And the rest of the video, I'm going to go through technical details and explain why I use this kind of system to demonstrate that happens. And now I've got to stop before I get a heart attack. Now this is a video on corporate finance. And I am going to put my videos together in these playlists, I suppose, and separate the project finance and the modeling and the basic modeling from the corporate finance. But this is corporate finance. And right now I'm working on a report. I got some Damodaran data on that report. Now, when I haven't made a video in a little while, and I'm reluctant a little bit to talk about the cost of capital because I've read articles that say basically nobody really pays any attention to these cost of capital estimates, and people may spend so much more time on the uh, uh, on the cash flow forecasts and on all our project finance techniques and blah 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 blah. Now, the here I'm going to use some tools. One of the tools is this thing that I get from Fred, and you can do it yourself, the Federal Reserve Economic Database, but this is a trend since 1980 in a 10-year treasury and a 6-month treasury. And anybody who says the cost of capital hasn't gone down, whatever, you're crazy. Okay? Now, here is my proposition. Here is what the theme of this whole video is going to be, and I'm going to show you some ways to evaluate the data and look at stocks, something I have no business of doing, because if I ever watch these horrible, disgusting television shows like CNBC or whatever, Fox or whatever, oh God, are they irritating. This cost of capital has caused stock prices to go up. Duh. There's been some, when we have a cash flow and we have a lower cost of capital applied to that cash flow, it's caused the market to go up. Is that a shock to anybody? Now, then we go through and we look at this market. Oh my gosh. Here is the S&P 500, and we'll compare that to the Dow and show basically if you're looking at the Dow or the S&P 500, it's the same thing. The correlation and the beta between the two is so absurdly close. And here is an index that takes a 10-year treasury bond and just creates you take the interest rate on the treasury bond on the yields, and you don't compute capital gains, but you just compute the index. And when you read how people compute the equity market risk premium, which is the centerpiece behind any cost of capital evaluation, you see that people basically take the index on the stocks and subtract the index on the bonds. And they don't correctly account, at least not that I've seen, they don't correctly account for this stock price has gone up because the cost of capital has come down. So if you're going to look at one of these reports on the equity market risk premium, and do it for different countries, where they essentially take the index of the stocks and the index of the bonds, and they don't account for the capital gain that's occurred because of the declining cost of capital itself, you're not getting any sort of representation at all about what a company is earning. Now, in other videos, I'm going to make a series of videos on this stuff, and apparently nobody looks at it anymore. I'm going to show you why you get completely different betas if you use different indices, and we'll talk about some country risk premiums, and we'll talk about some evaluation of alternative methods using the market to book ratio to get some data. Here is another graph. This graph shows that the corporate profits, the returns companies are actually earning, we'd have to really understand what kind of return on investment they're making underneath this this line, but the corporate profits have been kind of here, and the stock price has gone up here. And you can say, I'm giving up. Like me, who cares? I mean, I'm so poor. The stock prices, if you might say, who knows what's happening to stock prices? What a waste of time to even do a little analysis. But I did some, okay? And here's what I did. And I am going to try to explain this. And I have essentially, out of all of this stuff that I go through, levelized costs, renewable energy analysis, I'm doing some work on hydrogen analysis, modeling. I have two things that really may be of worth, have some value. One is this solving all the pain points in project finance with this UDF method, and I'm not talking about that today. And the other one is kind of our corporate finance version of that. Now, what I did was I just took the Dow 30 and took out the financial companies, and I added a couple more. I added Amazon, Google, Tesla, and General Electric. General Electric used to be in there. Why not include them? I don't know why. You just take a company out just because it's got low earnings. That seems to bias things a little, doesn't it? And it used to be, of course, the most valuable company in the world, blah, blah, blah. Now, what you do is you just put the tickers in, and I go to Market Watch, and I go to Yahoo, and the big innovation is now with Market Watch, you can get just about any. It's just remarkable that you can get any company in the world. And then I upload the data. Now, this file I'm going to put on the spreadsheet, and I've got another kind of file that goes along with this. It's in chapter number 1 of the stuff, and I've got lists of utility companies, companies from India, Malaysia, Pakistan, yield co companies, mining companies, airline companies, insurance companies, 2 airline companies. I shouldn't have two. And for each of those companies, here's our Dow one that I'm looking at right now, I also have this a stock analysis where we just read the stocks and compute the betas by hand and compute the IRRs and compare that with those graphs that I just showed you. Okay, so you put the ticker symbols in here. Now, the advantage of using the Dow is then once you do this, I'm going to just right click, and I've added a whole bunch of this. But if we want to go to McDonald's income statement, we download this, and there's a bunch of crap here, and eventually you get from Market Watch, you go down and find their revenues and their operating expenses, and then you get the balance sheet, and then you get the cash flow, and you get the summary. Now, I am making this proposition, and I'm going to show you some implications of all of this. And my proposition is that, well, it's kind of obvious. If we look at stock prices and compare the stock prices, so you read in the stock prices and some economic data on exchange rates if you have different countries, and the 10-year bonds to get the CAPM, and this is all automatic. And I know you have Bloomberg. So what? You paid a lot of money for something, okay, or whatever it is, IQ, whatever it is. Now, once you download these and get this data, we can look, and I've changed this a little bit. So let's start with looking at what's happened to some of these companies, and let's start with the revenues. And for me, what this demonstrates is, and then let's look at the EBITDA, and down here, let's look at the CapEx. Okay, now for this graph, you see it says year 1, 2, 3, 4, 5, and then it says quarter 1, 2, 3, 4. There's overlap here, but I get the year and the quarter, and these are quarterly. This is quarterly data, and I try to evaluate what's happening to the most recent quarter. And then on this page, I also show you some real. Just 1 minute. What in the heck is going on? Okay, I show you what the expected growth rate that's published by Yahoo, and they publish all of the EPS growth and the quarterly growth, and they give you the past growth, and they say Coca-Cola is going to have in the next 5 years a growth rate in earnings of 9%, even though when you look at their historic revenue growth, it's gone down. EBITDA has gone up and down, but down. CapEx notably have gone down. And then I do this on a quarter by quarter basis. So we use all of the information. And I didn't do this before. This time, perhaps let's put the up here. Let's put the look at this. When I do these, I always realize I should be moving things a little bit down, perhaps. Where should I put that? Here. Okay. We've got the revenues, and then let's get the EBITDA on a quarter by quarter and the CapEx. Let's do the same thing. And we're going to that now look at how much growth there really has been in the company, and then compare that to the stock price. In fact, let's, instead of showing the CapEx down here, let's show the stock price. And you just read in the stock price, and this is the kind of remarkable thing. Now, the stock price is a little bit tricky because it goes year by year and then quarter by quarter. This is the last stock price. And let's go to the top and look. Let's just take a tour for the Dow companies. And what do I have here? Oh God! Sorry about this. I think let's leave out the freeze pane, perhaps. Okay. So we have Amgen. It's very embarrassing. I don't know who they are. The stock price has gone up. The revenues have gone up by 2%. EBITDA less than that. That's kind of interesting. They're actually spending money. Then we go to Apple. Apple had this big increase in a year. Now, if we look at the quarter by quarter, we can see this one, and I have a different list. Here's Apple, and you can kind of see their revenues did go up. Their stock, no, this is the stock price, excuse me. The stock price skyrocketed by 39%, actually over the annual period. The EBITDA went up by 14%. The CapEx went down. And we're going to see a common kind of theme here. This one, the stock price is 11%, EBITDA 1.9%. And we can go back and forth. I think I'm just going to go through company by company. Here's Boeing. Of course, they've had all their problems, so their EBITDA was negative, and their revenues have gone down, so we don't really look at them. Caterpillar, revenue 2.2% growth, EBITDA 9.5%. They're cutting some expenses somewhere, and then the stock price has gone way up. And I need to put the title on this one, and I'm embarrassed that I didn't, but I'm just going to keep going. Chevron, revenues down. Stock price, whatever. Cisco, revenues about flat, and the stock price has gone way up. I'm now contradicting myself. Okay, Cisco. Okay, and we have the growth in the stock price 14%, EBITDA 0.69. Obviously, unless you're expecting some shocking kind of event, it's obvious, I don't have to say it, but the stock price is going up because the cost of capital is going down. How could we not say that? Coca-Cola, we've already looked at. Disney had a miserable kind of result, and the stock price still went way up. We're just going on and on. Dow Chemical, same kind of thing, although we don't have quite the information. Home Depot, revenues 8%, stock price way up. Okay, let's get the same thing here. I really should set this up so it's got the same thing. I end up changing this kind of daily. Stock price 19%, EBITDA 7%. If you're not believing that the stock price has gone up by more than the inherent cash flow growth, that's kind of crazy. Now, every single time the expected growth in earnings is dramatic compared to anything to do with the EBITDA. Okay, that probably comes from company estimates and everything else. You know that. Revenue 7%, and okay, we're just going through company by company, and we see very minimal growth in revenues, sometimes a little more growth in EBITDA. And I need to put CapEx back down here because what we're going to see is that typically the CapEx has been really declining. Revenues down. Revenues go up. Okay, Microsoft is, of course, a big exception. And then we have Nike and Procter and Gamble and Salesforce. Why they're in the Dow, I don't know. Verizon, the same sort of trend. Very limited growth in EBITDA until, of course, you get to Amazon and revenues 29%, EBITDA even higher, and CapEx have really gone up by a lot. And then just for another companies that's not in the Dow here, Google revenues 19, sales growth that, and let's look at what happened to their stock price. Maybe I did this a little bit badly, but so the stock. Let's put the stock price up here like we did before. Stock price has gone up by 22%. EBITDA 16%. Everybody the same story. They actually had a little bit of growth in CapEx. And, we could look at Amazon on this one. Okay, and I hope you would download this and you put in your ticker symbols. And there's one bad thing about this, which is really pretty bad, is that it goes to MarketWatch to get the data. It goes to Yahoo Finance to get the stock price data and some other data on betas and other things, and it just clunks along. And it could take 45 minutes to do this, and so you'd have to watch some YouTube videos, put it on a different computer, to whatever you want to do. And that's I'm acknowledging that. Then we can look at Tesla if we want. Of course, the stock price is gone way up. I don't know if they actually have a little bit of EBITDA. And then finally General Electric, and the stock price has gone down, and EBITDA has gone down too, and even more, and their CapEx has just kind of stopped as well. All right, so that should tell you if you're looking at an index. And I'm going to halt this file for just a minute. And in our, did that chart work? Why did the chart work when I closed it and opened it and not work before? And so you go and you read in all of the data. Now, what's happened, and I'm going to do this in a separate video, is that the S&P 500, if I go from 2016 to 2021, the S&P 500 has gone up by 19.6%, The Dow itself, the Dow 30, not Dow Chemical, has gone up by 18.6%, about the same time. And notice the beta is 1. And you can get the beta for this. The reason I did it is 5 years is you get the longer term analysis. And when you have these dramatic increases in shares, how many times do I have to say this? It's kind of ridiculous. If I press false to all and you do the same thing, and it's easy. It works. It really does work. I've worked on this for so long, and I'm going to compare this to the 10-year Treasury. Now, for the 10-year Treasury, I don't compute a capital gain. I just compute, here's the yield, and we just increase the yield. Now, when you do this sort of thing, sometimes you well, there it is. The yield on a Treasury bill, a bond, a 10-year has been 2.646%. S&P 500, 19.6%. Oh my gosh, what's the equity premium, risk premium? And then you can go back up, down, and start this at different points. Let's start it at 2004, maybe a little bit before that, and then you get the same sort of thing. I've got to use my NA thing to take these graphs out of it, and why do I have the flat one there? But okay. We have the Treasury bond. I hope I have the Treasury bond. And you might say, that means we should be expecting, here, it's 8% minus 3%. And we said, that's the equity market risk premium. And I think, when you do this, you can see the start of different periods. Now, it's very unfortunate. When you download this from Yahoo Finance, you can see the difference in the volatility. I guess I was wrong. There was no problem with this. Let's look at, again, the 10-year bond, and then let's look at corporate profits after tax. How's that? With inflation. And then you can kind of see the phenomena, the exact phenomena we're talking about, that the stock prices have gone up. Actually, corporate profits have gone up by about, not so much different than the Treasury bonds. And here's the risk premium. If we measure this minus this, we get the risk premium. But that includes all of this crap where it's clearly got some capital gains, and it's not reflecting the true returns from the return you're earning on a stock relative to the return the return the company is earning relative to the I can't get a word out. God. Relative to the Treasury bills. Here's another graph. Of course, it's heavily affected by the starting point, and you see that this, even when you do this, you see that the long-term returns, people are now, the young people are probably expecting to earn 10% forever or something like this, and then you can add a company and kind of evaluate what's going on for that single company. Okay, that's on the website, this one, and I modify it occasionally a little bit here and there. I have to press this calculate button, and if you're comparing, for example, right now, let's put false to all, and I didn't really. I wanted to compare the S&P to the Dow. I'm very afraid to compare it to the NASDAQ because the NASDAQ has probably a survivorship bias that's extremely important and can be a little distortive. And I didn't put a German index or anything else in, but we could do that. But when we do that, we'll have to adjust for inflation. In fact, we can adjust all these things. Okay, now I'm in my system where you download all the Market Watch and all of that stuff. Okay, and um, this time let's let's concentrate on the capex, and let's look at our ratio of capex to depreciation. Now the theory is, and maybe we'll just look at the kind of periodic capex here. And I just had a title here, and I'm good. Okay, I'm going to keep going. I have to keep going. Now, if we go through company by company again, okay, we can see, let's start with the first one. The capex have gone down, a negative growth rate in the capex. The capex to depreciation have gone down even further. They're not replacing their capex. Apple, their capex has gone down, while their EBITDA has gone up. Maybe we can even put the EBITDA here, but let's not. Then we'll go to Boeing. Their capex has gone down, and their capex to depreciation have gone down. We didn't get it. I wonder why. For Caterpillar, for Chevron, it's gone down. Cisco, a little bit down. Coca-Cola capex to depreciation was kind of going up a little bit, not nearly corresponding to any growth. So how are they going to grow their earnings? Maybe through acquisitions. Who knows how they get these kind of 5-year growth rates in earnings, or maybe through manipulating the capital structure. But we saw that the again, the capex have gone down. I'm taking the growth rate from the first to the last, and then the capex to depreciation. Now, I hope you're saying, aha, here's what's important. Home Depot is not quite as bad, but remember, when we look at their EBITDA, their EBITDA has gone up by 7.73, and their capex has, oops, I was wrong about that. They actually have a little bit more capex. Honeywell, same thing. All the capex are going down, just about all. I don't know what if you think that's important, but when we try to apply this one, Mark was very different. Microsoft different, but for the most part, the capex are are declining, while the EBITDA is about stable and the stock price is going up dramatically. And hopefully you can start to analyze this, and it just keeps re-emphasizing the theme that there's a capital gain. There's a capital gain when your cost of capital goes down. It's clear evidence that the required rate of return is going down, not up. And that means that if you're trying to think that the stock price index is going to grow in the future, and maybe it will, maybe the cost of capital will continue to go down, all of that. All right. Now let's look at a couple of ratios and let's see what you can do there. So then if you want to just really start taking a tour of what's going on, let's take the forward price to earnings ratio. Of course, I got a distortion here, and maybe we'll look at all of this from a okay. Just a minute. Let's look at the EV to EBITDA ratio. Now, one of the things I go crazy about is comparing a EV to EBITDA ratio for companies with different asset lives. And my propositions generally on corporate finance is that we can do so much better with a terminal value than the classic methods. I go crazy that this way McKinsey uses this ROIC formula, which is 1 minus G over ROC divided by WACC minus G, is so wrong. And that's our EV to equity, and that's our EV to EBITDA and debt to EBITDA. They're so distorted unless you account for the asset lives. Equity market risk premium and country risk in when we're measuring the cost of capital, equity market risk premium is the number. And then I also say, oh, there are these. If we really are careful about doing any sort of statistical analysis, we have to include the time series, and so all of these kind of things are corporate finance issues, and I'm going to try to put these all together come up with a with a nice kind of step by step formula. But what you should see is obviously that the PE ratios and the EV to EBITDA ratios have gone up dramatically. And again, that's just whoops, we can't do bowling really, and we can look uh, 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 period by period, and we can see okay, oh, some of these PEs are all distorted, but then maybe the EV to EBITDA is kind of a more interesting way to look at it. And you can see that there's been a dramatic growth in all these ratios, except for Intel here. And that growth is reflective of a lower weighted average cost of capital. Unless you think the company has some massive future growth that you can't see in any of the real kind of numbers. Okay, enough of that. I think I'm going to stop this video. That is really enough. So what I'm going to do is make some more videos and a series of videos that really highlight some other information you can really pick out from looking